because we had so many questions in 2024 and we saw the market fluctuate so much, we thought that today we would have our mortgage broker, Julie Aragon with Aragon Lending. Julie's been a mortgage broker for over 20 years. And so we thought today we would ask her some of the questions that she's been hearing, some of the concerns from buyers in 2024, and some of the things that we can expect for 2025. Life is like Monopoly, every move counts. I'm Gia Silva, real estate broker and investor, and I have helped hundreds of people make smart, winning real estate moves. Julie, thank you so much for being here today with us.
Yeah.
I have so many questions about 2024, right? But I know as a lender, and a lender that's been lending for quite a while now, I'm sure that you've been receiving kind of like the same questions over and over and the same concerns specifically from first-time buyers. So let's just start with breaking it down. What were some of the most asked questions that you had from first-time buyers in 2024?
I would say the question we probably got the most was, is it the right time to buy?
Is it the right time to buy? Okay.
Right. We saw many of our clients who maybe their family, their friends, their coworkers all bought several years earlier and they saw rates increase. Do you know, I was going back between December of 21 to September of 2022, rates, they went from 3% to 6%. By October of 22, rates had gone to 7%.
That's right.
It's like 3 or 4 points in 7-8 months.
Yeah.
So it was a big jump quickly. And so we had a lot of our clients saying, well, wait, what's this going to do to prices? Are they going to come down? Is it the right time?
So they were saying that. So help me understand that part. So were they saying that right when interest rates were super low in the 3s and they were seeing that prices were like skyrocketing? Were they saying, okay, something has to happen here. Should we wait until prices come down?
I think that happened in 23, but by 24, they weren't moving. We've kind of been above 6% since that fall of 2022. So I think last year it was, well, nothing's happened yet. Prices haven't come down and we still need to buy a home. We need to go on with our lives. So I think clients still have that affordability, squeeze, but now it's, okay, so what can we do? What things levers can we pull to make this move happen?
Okay, so basically back in now just last year, 2024, it's been more like interest rate driven, you would say? I
say it's fear.
It's fear.
I see first-time buyers.
Okay.
The concerns, right? There's some that are like, I want to buy a home and this is, they don't have the fear. But I'm saying the ones that are having concerns, or questions, it's a little bit of fear with regards to affordability.
Okay, so regards to affordability, but not necessarily rates. It's more if they can afford it themselves.
Right.
Got it. Okay, if they can afford it themselves. So that's the number one question, right? So affordability, should I buy? Can I even buy right now? Mm-hmm. So then what are some of the things that you do with them in order for them to figure out, is it the right time to buy for me then?
Right. So a lot of times it's looking at the budget, right? Because the bank might say you can afford to buy this home, but initially that monthly payment feels like too much, as compared to rent. So really going into the budget to see, okay, well, how much are you paying in rent? How much has your rent gone up over the years? Because that's an exercise, it's not just this moment in time, but let's go back 4 or 5 years. What were you paying in rent then? How much has it gone up?
Okay.
If we continue to see this, what could your rent payment look like in a few years? And then looking at all of the other things that maybe the money that's going out of the house and where we can find some money to increase that affordability. For instance, the tax benefits. Okay. So when you own a home, you can write off mortgage interest, you can write off property taxes. And I know we hear that, but until somebody breaks down and looks at what tax bracket they're in and what that monthly payment could look like, it doesn't really become real. I think a lot of our clients don't consider that, but when we do the pre-approval, we're actually gonna break down all of that math.
Okay, so what you're saying is that you go through an exercise, right? So you kind of go through an exercise with them of, this is how much you've been paying in rent all of these years. This is what you can anticipate if rent goes up, right? Which it usually does, of course. And then based on that, also some of the savings that they would have by becoming a homeowner. So you're doing all of that exercise with them.
So when we help a client with the pre-approval, we're gonna break down what the total monthly payment is, what's going out, but then also what's coming back to them.
Okay.
So when you buy a home, since you're gonna have that tax benefit, property taxes, mortgage interest, what that looks like in terms of a monthly benefit to them, as well as how much of that payment is going to pay down their balance.
Okay.
Because that's also a form. So we have clients who right now they're renters and they they make good money, maybe they don't have kids yet, they're saving at a rapid pace. Well, when you buy a home and you have principal pay down, that's a form of building wealth and building equity. So you can't ignore that. Maybe you're not gonna be able to save $3,000 a month anymore. Maybe it's only $2,000 or $1,500, but you're also paying down your balance and you're building equity that way.
Got it. So, so the exercise from what rent would be in the future if you kept renting, what the benefits would be when you become a homeowner. What are some of the other things that you go into to kind of show them, right, the bigger picture of this is what it would look like if you were to buy a home, this is what it would look like if you didn't buy a home?
Right. So we'll do that exercise. We'll forecast rent over the next 60 months and then compare that to a purchase scenario.
Okay.
And taking, using moderate, like 5% appreciation rates, and then looking at, 60 months later, the renter versus the homeowner, who's ahead. Because it always seems more expensive to buy.
Yeah.
It just does.
Yeah, it always does. And I see all this of, the cost of waiting, right? The cost of waiting, but what is really the cost of not buying? If you really think about it, right? So what is the cost of not buying aside from the appreciation that you're gathering with that property?
Stability, it's, just not having to worry, like, is my landlord gonna list the building? There's all those things that are kind of like intangible, as well as just the math. And we've seen all of the articles come out on how homeowners, outpace renters in terms of wealth and stuff. So in our meeting, we're gonna talk about their budget, what's their ideal monthly payment, and then go through an exercise where we're looking at where their money is going and where we might be able to find ways to cut expenses, and then that can increase their purchasing power.
Perfect. Okay.
So another thing that might be keeping some people from buying is the down payment. A lot of times maybe people are in their ear, parents say you need 20% down, and that's just not the case. And so we show the math and see why, if you can put 5-10% down, why that might be better long-term versus saving for 20%.
Got it. Okay, and so what would you say? I have those buyers, I have those consumers that are like, it just feels better to have saved the 20% so that I avoid mortgage insurance.
Yeah, and I always tell my clients, I promise you, your Wi-Fi will cost more than your MI if you have good credit.
Yes.
If you got good credit and it's a conventional loan, you're putting 10% down, your MI is under $100.
Okay.
And my spectrum is more than that. So to look at that and say, okay, well, if I have to pay MI at less than $100 a month for a year, that's $1,200, right? But I got to buy, let's take $1 million property, putting 10% down.
Yeah.
Okay, so $100,000 versus saving the extra 100. Because how much do I have to earn to save an extra 100,000?
Yeah.
So I would rather pay $1,200 cost to get that house early and lock in my price, and then let the appreciation do its thing, and then I'll refi and drop the MI at that time.
Exactly, because it's also, right, if we just put it into perspective, it's not just those $1,200, right, that you're putting in, but it's also what that property that you may like is going to cost in the time where you have saved the extra 10% that you were hoping for.
Right.
So it's kind of like looking at the whole entire picture and going like, okay, honestly, which makes more sense?
Right.
Because a lot of it is just a feeling, right?
Yeah.
Like you're mentioning a feeling of like just having 20% to put down.
Yeah.
Now, if let's say someone goes, okay, well, Julie, that makes sense. So then I guess I don't have to put 20% down to buy my first home. How soon would I be able to refinance, and what would that look like in order to get rid of MI, mortgage insurance?
So it depends. It depends on how the market's appreciating. We had situations when the market was, going up 10, 15% in a year. Like, that's not sustainable.
Yeah.
But I would say 5-6% is a good, expectation for where we live.
Yeah.
So, if you put 10% down, it might take you at most 2 years.
Yeah.
But I've seen it as quick as 6 months, 9 months, we're able to drop somebody's MI. If they put 15% down, it could take 1 year, because now we only need to have appreciation of 5% to have that 20% equity.
So another concern is, I'm sure, closing cost. Now you're saving for your down payment, whether it's 5%, 10%, 20%. And what I'm realizing is that a lot of first-time buyers maybe don't account for what they will need for closing costs. So share with me, as a lender, what are some of the closing costs that they should be considering?
Yeah, so closing costs are in two parts. So one are actual fees to people, escrow, title, appraisal, that kind of stuff. usually you can estimate about 1% of your purchase price for closing costs. I do not recommend any of our clients paying points right now, just because we believe that rates will come down and there's a refi in their future. So we're not going to sink any extra costs into buying down a rate when they might keep the loan for a year.
Okay.
The second part of closing costs is your prepaids. So if you're going to include taxes and insurance in your payment, if you're buying $1 million home and let's say taxes are $1,100 a month, you're going to have to front several months to the lender, which is going to increase your closing costs. So I tell my clients, you've been able to save sometimes a couple $100,000, $100,000 to put down. You can save. You have the ability to save. Why don't we instead keep your closing costs low? Don't impound. I'll tell you what the total payment is, and then you set aside $1,300 or whatever that amount is for taxes and insurance, and then that's going to bring your overall closing costs lower. And then you manage your own money. You don't need to send it to the mortgage company.
And you would say, and I would also recommend that for people that are very much disciplined, right? Because I know that there's definitely consumers that are like, no, I want to have my payment fully amortized, right? Principal, interest, taxes, and insurance. So you would say that you'd recommend that for people who are very good with savings.
Of course.
Yeah. Right. Otherwise, so let me go back to this. So if the account wasn't impounded, if their payment is not impounded, they wouldn't have to pay those reserves right away, for the closing costs.
So in some cases, it can be $8,000, $9,000 less in closing costs because they're not fronting that money and waiting for the bill to be due.
Got it. Julie, tell me about concessions.
Yes. So concessions are where we ask the seller to give us a credit to pay for things we want. So sometimes it might be for closing costs, which is helpful. In this market, we are seeing some sellers give concessions for a 2-1 buy down. Okay. For instance, if interest rates are at 6.5, then we can ask the seller for a credit. And usually it's about 2% of the purchase price. Depends where rates are, but call it 2%. And we use that money to temporarily buy down the interest rate. So if rates are at 6.5 in year 1, the buyer's monthly payment is going to be based on 4.5.
Got it.
In year 2, it'll be 5.5, and then it'll never exceed that 6.5 rate, which is the rate today if they hadn't done a buy down.
Got it. So you're saying that it'll go up 1% on the second year. It'll start with a very low rate, and then the next second year, it'll go up 1%. And then after that, for the rest of the years, it'll go to whatever rate is today.
Exactly.
For the
locked
rest.
in. It won't go up again. And why would we do that? Well, on a $1 million home, buying down the rate 2 points, that's about $1,000 less of a monthly payment. It's a big impact.
Yeah.
So some of our clients are like, okay, well, my kid's gonna be in public school by, next year. I just need to get through right now. I wanna lock in. So they have, their budget might be changing where they know, okay, well, if rates stay at 6.5, I'm okay because, I can make that payment, but I want a little bit of relief right now for various reasons.
Okay. And then what would you say that could be some of the cons of that 2-1 buy down for somebody, for a buyer?
I don't think for a buyer there's a con. I think for the seller, giving up that money, but they have to look at if the property is not maybe getting as many offers or eyeballs as they want, it's worth it to give 2% to help that buyer have a more affordable payment, because then they can offer you more money.
Exactly. Yeah. Okay. So that will always work, and I've seen it, right?
Yeah.
In some markets it'll work. For some type of properties it'll work. Yeah. But in some markets where properties are moving very quickly and they're getting multiple offers from buyers that are not asking for a 2% from the seller, that may not work. So I totally get it. Okay, Julie, so we talked about some of the concerns that you heard from buyers back in 2024, affordability, like can I actually afford to buy a home? Closing costs, what is it gonna take? And of course, do I put 20% down, right? Do I need to save for 20% down because I absolutely wanna avoid MI? And what I'm gathering too is that even when I speak to my clients, and it's, a lot of it is fear-based factors, right? We've realized that. So Julie, any other advice that you would give to first-time buyers now going into 2025?
I would say to talk to somebody like me early, before you go on Reddit and look at all the forums, can I afford to buy? Have a discussion with a mortgage broker or a bank and see what your options are. And if it's not the right time, they should be able to tell you and put a path for home ownership in the future.
Absolutely. Awesome. Thank you so much for being with us. That was so helpful. And I can't wait to see how many renters actually become homeowners in 2025.
Exciting.
So if you found the video insightful and helpful, make sure to comment below, maybe your specific scenario, subscribe, like it, and we'll see you soon.